time in the market is better than timing the market. So you have probably seen this advice from famous investors like Warren Buffett telling us it's pointless to try to time the market, that we should just buy and hold forever. But is there more than meets the eye? Well, personally, I went down the rabbit hole to dig into the hard numbers behind this quote. And listen, I actually discovered some hidden findings that may actually surprise you. So in this video, I'll lay down the case from both sides and allow you to be the judge. No holds barred. So if you love videos like this, remember to show your support by subscribing to us. Oh, and please help hit the like button as well for me to hit my KPI. So here's the thing. This conversation around timing the market was once again brought to the attention of the investing community during the Fundsmiths annual shareholder meeting. So the argument is relatively simple, assuming the various scenarios. So first, if you were to invest in the S&P 500 with dividends reinvested for 20 years from 2002 to 2022 and just stay fully invested throughout, it would have given you over twice the amount of money compared to when someone timing the market and missing the 10 best days in the market. So there are some truths here when we think about it. So within a span of 20 years, there's 7,305 days. Yes, given that not every day is a trading day, and if you were to deduct around 35% of that number to account for both weekends and holidays, that's 5,113 days. So just missing the 10 best days, your annualized return will be punished from 10.7% per annum to 6.3% per annum. So in percentage terms, that might sound small. But don't forget that investing is a compounding activity. A 4% difference doesn't sound a lot, but when you compare the difference in absolute dollar amount, it's 2 times more over 20 years. So with that same train of thought, missing the 20 best days would make your returns go down to 3.4% per annum. The worst, missing just 40 best days, and your returns would actually go into the negative territory, even after 20 years. Negative. Congratulations on holding on for 20 years but making zero returns. Similarly, an article by CNBC back in 2021 echoes similar sentiments with an eye-grabbing headline. This chart shows why investors should never try to time the stock market. Long story short, looking at the data going back to 1930, Bank of America came to a similar conclusion that if an investor missed the S&P 500's 10 best day in each individual decade, the returns would stand at only 28%. If on the other hand, the investor actually held steady through the ups and downs, the return would have been a mind-staggering 17,715%. But here's the interesting thing. That's only part one of the story. At least until now, we have been told the story that it's extremely unlikely that you'll be able to time the market perfectly. And even if you do, you are at the precarious position because you would have missed the best few days. Your overall returns profile will take a significant hit. And I think for the layman, there's no doubts or even arguments around this phenomenon. But here's the second part most people don't talk about. In that same piece, actually published by CNBC with the data from Bank of America, there were 2 additional columns that were intentionally excluded. What if, on the contrary, rather than just excluding the best 10 days per decade, we exclude, on the flip side, the worst 10 days per decade? So do you want to take a guess what the returns would be instead? So it's not 1, it's not 2, it's 3.79 million%. Yeah, if you exclude the 10 best days, your returns would be 28%. If you buy and hold and forget, your returns would be 17,700%. If you exclude the worst 10 days, it's 3.79 million%. So for those of you watching this video up until this point, you might suddenly feel enlightened. So rather than trying to catch the stock market bottom, why not just focus our efforts and attention on how to avoid the big market drawdowns instead, right? So I think we have to hold our horses. So here's the key thing. Regardless of whether you're trying to time the market tops or even the market bottoms, they are equally hard, if not near impossible. Truthfully, I think it's not worth the time to do so. See, when we look back at the past 5 bear markets, the 2022 inflation interest rate driven bear market, the 2020 pandemic bear, the 2008 Great Financial Crisis, the 2000 dot-com bubble, and the 1990 Gulf War. There is a similar pattern in how the best and worst days actually present themselves in an entire stock market history. So according to hard-fought funds, avoiding the market's downs may actually mean that missing out on the ups as well. So 78% of the stock market best days occurred during a bear market or during the first 2 months of a bull market. So good days actually happened more often in bad markets. Sounds counterintuitive, right? So from their research of the time period between 1994 to 2023, 50% of the best days occurred during the bear market, 28% happened during the first 2 months of the bull market, and only 22% happened during the rest of the bull market. So let's take the 2022 bear market for example. So I extracted the daily performance of the SPY, which is an ETF that tracks the performance of the S&P 500. So I compared the daily closing prices. So the best day during that 10-month period, January to October of 2022, was the 24th of June 2022, which closed 3.18% higher than the previous day. But then they went on to experience 4 red days right after. So the worst day, it was the 13th of September with a negative 4.35% closing, coming right after 4 consecutive green days prior to that. So if to push this back by one bear market, looking at the 2020 pandemic instead, you can observe a rather similar pattern, where the best and worst days tend to cluster together. And if you have to still remember, there were even double-digit drawdown days, but they were intercepted by large green candlesticks as well. An example would be from the 12th of March 2020 to the 16th of March. The first day, the S&P is down negative 9.5%. On the next, it's up 8%. And after the weekends, it's down nearly negative 11%. Therefore, this explains the so-called clustering effect between the best and also the worst days. So unless you are able to confidently say that you can predict accurately on whether the market will have its worst or even best days, you are probably going to miss them both in your attempt to try to time the market. However, here's the kicker. If we were to exclude both the best and worst 10 days per decade, we would still be able to achieve decent outperformance over the buy and hold strategy, with a 27,000% return versus a 17,000% return. So the million-dollar question, is there really a reliable way for us to try to time both the ins and outs of the market, avoiding both the best and worst days? Interestingly, while I was searching around for answers, I actually found out something that came close to it, which is the SPY 200-day moving average strategy. And it prides itself on beating the buy and hold. So what is the 200-day moving average? So it is one of the most popular tools or indicators used by my technical analysis friends to determine whether a particular stock, an ETF, or anything under the sun, whether are they on an uptrend or whether they are on a downtrend. Simply put, it's the average of the previous 200 days of closing prices. So in simple technical analysis terms, it's bullish when the price is above the 200 moving average, and it's bearish when the price is below the 200 moving average. And to quote Paul Jones, who's a successful American billionaire hedge fund manager, and I quote, "My metric for everything I look at is the 200-day moving average of closing prices. So I've seen too many things go to zero, stocks and commodities. The whole trick to investing is how do I keep myself from losing everything? If you use the 200-day moving average rule, then you get out. You play defense and you get out." Essentially, there is only one concept you have to grasp here. The trend is your friend. The rules for this strategy is rather simple. So here's the 4-step trading rule. If you are long on the index on the last trading day of the month and the price actually closes above the 200 simple moving average, you stay long. If the index actually closes under the 200 simple moving average, you sell everything and you hoard cash. On the flip side, if you're on cash currently and the price actually closes above the 200 simple moving average, you go back and long the index again. And if you're in cash and the index actually closes under the 200 simple moving average, you keep your cash position. So the results, it's actually quite interesting. So according to backtested data from the year 2000, the system with that particular 4-step trading rule had 13 entries and 13 exits, and they actually avoided all 4 major bear markets in the past 22 years, and outperformed the SPY ETF by nearly double. So the core idea is to essentially ride on the momentum of the market, and through this systemized approach, attempt to avoid both the best and also the worst days of the market cycle. Of course, this is based on someone's system of rebalancing the portfolio at every month end, simply by looking at the 200 SMA of the index. So some of you might ask, why don't we code a bot or even a program to follow these rules on a daily basis, making it even more timely? Theoretically, of course this is possible, and in fact, it might even be highly encouraged for you to stick closer to the trading rules. However, I would also like to highlight the potential downside of this strategy. First, this research is predicated on back-tested data for the last 20 odd years from the year 2000. So I've always loved the quote from Mark Twain. It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so. So like most things in life, it works until it doesn't. Secondly, this backtest was done in a very controlled environment with many assumptions in place. So we have yet to consider a few pragmatic but important issues. So for investors that operate in a jurisdiction that enforce capital gains taxes. So from the backtest, you can actually observe that there were multiple periods where the momentum didn't continue on for more than a year. And by realizing the gains prematurely, you will be subjected to hefty tax bills. Also, we did not consider the cost of commissions throughout the process as well. So depending on the broker that you use, if you have a sizable capital coming in and out of the market frequently enough, especially if you program a bot to follow the 200 SMA on a daily chart, your returns might be hurt by the commissions. So the worst case scenario is if the market actually chops sideways and it flirts around the moving average. Think about it. If the market closes above, below, and that's when your bot or your program will enter and exit based on the rules that were set prematurely. And that's when all the commission charges will eat into your returns. Thirdly, of course, it's always about the operator, i.e., the investor himself. So compared to a buy and hold strategy, where most passive investors can virtually buy and then forget about it, if you are taking an active approach to employ some sort of strategy like this, you will need to still monitor your program. Make sure that the bot or the program doesn't do anything stupid. More importantly, you will also have to trust your system and to not interfere too frequently with your discretionary judgment, which will ultimately defeat the purpose of the strategy because it's supposed to be methodical and emotionless. So the good thing about backtesting is that you are given the environment to think clearly and to think logically. However, when it comes to the real execution, with a lot of money on the line, our actions and judgments might be clouded. From the CNBC table, you can also observe that there were moments in the decade where despite missing both the good and bad days, you'll still underperform the buy and hold strategy, which kind of suggests that it's not necessarily a foolproof way. So there you have it. This is our unbiased approach to breaking down time in the market versus timing the market. So if you were to ask us for our opinion, we have to go back to the ultimate objective of the investor himself. So if we are really coming in from an angle of being a passive investor, freeing up our time for something else, then I would think that buy and hold should still be the main strategy. So what is your take on this after hearing from both sides? I look forward to understanding your perspective in the comment section down below. So this is CK from Piranha Profits signing off. Till next time, keep winning.